Your monthly mortgage payment could probably go up by as much as 20%, and most Canadians have literally no idea that this is coming. If you are one of the Canadians that has a 5-year fixed rate mortgage and you got it in 2021 or 2022, you will be experiencing somewhere between a $400, $800, $1,000 or $1,200 increase on your monthly payments. And no doubt that is going to affect the bottom line. Now, I've talked about this before, but in this specific video, I'm going to get into the 3 specific moves our clients are making right now to prevent against losing their house, being completely broke, or just literally having to spend more money on mortgages than they really want to. So here's the stats. 40% of Canadians have 5-year fixed rate mortgages coming up for renewal in 2025 or 2026. Stat 2, payments could rise between 15 to 20% at renewal, and that's not something new. 60% of Canadians will pay more, despite the fact that mortgage rates have come down almost 2.5% since the peak of 2022-2023. Since the peak of 2023. Even though rates have dropped down and they appear to be coming back up, payments are rising. And we're seeing this with our clients every day right now. The average Canadian is going to see a payment increase, and it's going to be 15 to 20%. And the stats back this up. Those sneaky variable rate fixed payment loans could actually bear the biggest brunt of all of it, because a lot of people didn't increase their monthly payments, and they could see increases by as much as 40% on their monthly payments. There's actually a small group of Canadians that, believe it or not, might come out ahead. And the secret, not really a secret, it's how they structure their mortgage and their money, which I'll explain to you right now. So getting into the numbers, the average Canadian mortgage payment is going to work out to be from $2,500 to approximately $3,000. That extra $500, it's the difference of a car payment, all of your groceries, and maybe even a portion of your kid's daycare. And the crazier thing is, debt service ratios have come down 10% from the peak, while they're about to rise by up to 18%, which is a massive dent to your wallet and the amount of money that you can spend on things that matter. Debt ratios may be up as high as 30% already in reality. If you're already stretched out, this isn't about numbers though. This really just comes down to peace of mind. And I've personally been there and I'm experiencing it with my own renewals right now. But here's the things our clients are doing right now and that can help you out. Number 1, it is extending the amortization of your existing mortgage. People don't believe that this is possible, but you can actually go back and sometimes go back further than your initial mortgage amortization term. For example, you can extend your amortization back by 5 years, 10 years, as long as it's 30 years or less with a conventional loan, you can actually reduce your monthly payments. I'm not suggesting this is a long-term fix for everybody, but it can actually decrease your monthly payments and give you the ability to make that car loan payment or pay your kids' childcare. And number 2, you plan on revisiting your mortgage in the near future to consider the possibility of a lump sum to reduce your monthly debt and make sure to pay down that mortgage, effectively reducing that interest that you would have paid when the time is right. The big asterisk is don't do this blindly and expect your mortgage just to get paid off magically. Only do this if this is a fix for the now and you have a strategy to be able to pay it down more in the long term. And that requires some diligence, clear timing, and probably setting a goal so that when you're ready in the future, you start to pay down your loan. So my recommendation is to get started 6 to 12 months early. Here's why you can do it. You can essentially shop early. You can lock in rates up to 120 days, which is 4 months. You can negotiate terms and you can actually switch lenders. Now, people are doing this because the rate market, believe it or not, is on the upswing. And when rates are in the upswing, if you can lock in your rates now, it could be beneficial to actually have that mortgage rate set for the next 3, 4, or 5 years instead of waiting for your mortgage renewal term to come up. Here's how you do it. Number 1, pull out your mortgage statement, figure out your amortization, your loan amount, and have a general idea of what your home value is. Number 2, contact us. Don't contact your bank. They're not going to offer you good terms, and they're going to probably just try to lock you into whatever makes sense to them. Number 3, stress test your monthly mortgage payment based on your today's situation. When you talk to your mortgage broker or our team, figure out what could your monthly payment be based on the new interest rate and figure out if you can afford that. If you can't, then you should consider a refinance or restructuring of your finances. If you can, then it's okay. You can decide whether or not you want to lock in early or if you want to wait until the end of that mortgage renewal term and see what the rates are like at that time. Furthermore, if you do want to stay with your existing lender or you don't qualify, most lenders will offer an early renewal 4 to 6 months before the end of your term, or a reduced penalty if you decide to leave. Now, the third strategy is something a lot of people are considering right now. This is a refinance or a consolidation of debt. No doubt, COVID happened, people bought boats, vacation properties, cars, everything got more expensive. As you can imagine, this has impacted people's lifestyles and actually been a big part of why people are struggling at renewal time, besides the fact their mortgage payments are going up. So if you got car loans, credit card debt, anything else, as long as you have at least 20% equity in your property, there is a possibility to borrow up to 80% of the market value of your property. So why does it make sense? First of all, you can lower your monthly payments. Second, reduce your overall interest costs. You get 20% on a credit card, stick it in a 4.5% mortgage. You could reduce costs if you have a clear plan to pay that off. The third thing is it just simply reduces and simplifies your overall finances. Having money here, all these different places is a higher cost. And by actually consolidating this debt, you can reduce that cost and pay less money overall. There are a few things you should definitely not do given the situation. The first one is do not ignore your renewal notice and wait to the last minute. Way too many people call me 2 weeks before funding, and if their lender doesn't allow them to go into an open term, it ends up costing their money in the penalty. And if their lenders do go in an open term, it increases their mortgage rate from 2% to 10%, which is even higher added cost that they could have dealt with earlier. The second, even if you want to negotiate with your own bank, don't accept their first offer. It's never the best and it never will be the best. So always negotiate the best terms. And the third is do not assume that you're stuck where it is. You should be able to shop around, you should be able to get advice, and you shouldn't be stuck where you are. And if you are, that's a very rare occurrence, then there's usually a plan on how to get out of it. Biggest mistake that I see every single day from Canadians is waiting until it is way too freaking late to do this. So right now, the 3 best things I'm seeing our clients do, number 1, they're locking in rates today, even if they're 12 months out. They're securing an interest rate, even if they're not going to qualify early. This means we have a clear plan. We know exactly what we're going to do. And if rates go up, we're going to break it and cut it at that time. The second thing is they're building an emergency buffer. So many people I meet don't have any savings plans. And we're going to build out a clear plan, an emergency buffer in case something goes sideways when it comes to this upcoming renewal. And the third thing, honestly, I'm talking to a lot of people about possibilities of creating new income streams or tax saving strategies. This is massive because most people, they're setting up, they're thinking about the renewal, they're looking at the refinance, they're doing the amortization, but they're not thinking about how they're bringing extra money into the house or reducing the amount of money out of their house. Here's the deal. Yes, mortgage payments are going to go up 20%, 30%, maybe 40%. Yes, it is going to hit millions of Canadians, but you're not helpless, you're not alone, and you do have options available to you. So the steps are simple. Get that renewal letter, contact our mortgage team, review your options, lock in a rate and term, and then you should be in a better place than you started with. If you want to find out more, hit that description below. We'll set up a free call. We'll see if it makes sense. And if it doesn't, we'll tell you what to do instead.